everyone! Last week turned out to be a total disaster for Wall Street. The Fed made it clear it would not shift to a softer stance in the near future. However, market sentiment was not affected by a 75 basis point rate hike for the third time in a row. Traders priced in it a long time ago. The thing is that the regulator could raise the interest rate by 100 basis points. The dot plot suggests that the federal funds rate may reach 4.6% next year. Besides, the central bank is unlikely to cut it until 2024. Investors are going to painstakingly analyze the fresh reports which are due in the coming days. Apart from that, several Fed policymakers are going to deliver speeches, even though they will hardly say anything new, especially after Jerome Powell's speech. Investors are looking forward to their remarks. This week, the PCE index is in the limelight. The Fed takes into account this data when making monetary policy decisions. Durable goods orders and the consumer sentiment index are also on top. Watch this video till the end and leave your comments down below. Let's start. The US stock futures declined on Monday after a steep drop in all three benchmark indices. As the watchdog sticks to aggressive tightening, the risks of a hard landing are growing. Investors are extremely worried about such a likelihood. Jerome Powell noted that the chances of a soft landing or a moderate recession are likely to diminish. So speculators are bracing for a long recession. Shares of energy companies suffered the biggest losses yesterday, tumbling by 6.3%. Such a drop was triggered by falling oil prices. As for the earnings season, Costco wholesale stock sank by 4% after the retailer reported a decrease in fourth quarter profit. Market sentiment turned sour due to Costco's disappointing quarterly results, followed by the gloomy forecasts of several companies, including FedEx and Ford Motor. Traders are trying to guess how long a bearish trend could be. Analysts reckon that the peak of the monetary tightening cycle will occur approximately next May. It means that the stock market has 7 more difficult months ahead. However, it would be unwise to remain pessimistic in the long term. Analysts usually make their estimates by using the leading indicator. However, the stock market may begin to recover earlier than expected. Besides excluding dismal comments in Powell's speech, he also made some hints about a possible improvement. Some positive shifts may take place before the end of the rate hike cycle. Currently, markets are gripped by pessimism. Investors are going to build their strategies by taking in account both positive and negative scenarios. As long as the monetary policy tightening cycle continues, a bearish scenario looks more likely. The Dow Jones dipped below the psychologically important level of 30,000 and closed at the 2-year low of 29,592. At the start of the last week, bears tried to push the index even lower. Last Friday, the Dow lost 4%. In order to assess the possibility of a crash on Wall Street, we should study previous sharp falls, their duration and their strength. For this purpose, it's better to use the S&P 500 index. It has been dropping for the 9th month with losses exceeding 20%. The deepest decline on record occurred in 2008 when the stock market plunged by 50%. However, at that time, the entire global financial system was on the verge of collapse. As an example, we can take the pandemic decrease. At that time, stocks plummeted by more than 40%, falling for 23 months. Thus, on average, it turns out that the stock market might even be in bearish trend for about 16 months, with losses topping 35%. If we take January of this year as the start of the bearish cycle and assume it is over at the end of the rate hike cycle, then a downward trend may last about 16 months. Over the coming months, the S&P index may decrease by 10 or 15% before starting to recover. It's difficult to say whether such a scenario will come true. However, the current outlook is gloomy. The S&P 500 index dipped by 4.7% last week amid the Fed's hawkish rhetoric and its consequences for the economy. However, yesterday the S&P and the NASDAQ managed to rise by more than 1% as traders interpreted Powell's speech in a positive way. Apparently, they quickly realized their mistake. Bearish sentiment eventually prevailed, so the indices are now sliding deeper into negative territory. The S&P index was initially projected to decline to 3,800–3,700, with a potential drop to 3,600 and a possible rebound in October. However, it's clear now that it was rather an optimistic scenario. Like other indices, the S&P is sure to approach new lows. The technical outlook for the S&P does not suggest any short-term consolidation or recovery. The index has already broken through important support levels, notching a new closing low for 2022. This move may trigger a resumption of the bearish trend sooner than expected. As the S&P has gone below 3,910–3,880, it could return to new yearly lows below 3,630 level. We have already seen such attempts on Monday. After that, it is expected to test 3,580 and 3,500. A stronger support level should appear in this range. Its breakout may trigger a fall to the area of convergence of support levels of 3,230 and 3,190. The heavy tech NASDAQ slid down by 5.1% last week. Stock markets are in the red. The current bearish trend is unlikely to end soon. What's more, the US 2-year government bond yield climbed above 4%. It may soon advance to 4.5%. If so, it will be extremely negative for stocks. Now the yield is rising exponentially for the Fed funds futures for December 2023. If speculators continue to be guided by the FOMC economic projections and the key rate is hiked to 4.6%, the December futures will eventually jump to 4.6%. Given the current spread, the yield should approach 4.5%. The technical indicators also signal the probability of a further increase in the 2-year Treasury yield. The resistance level is located at 4.25%. If it is broken, there will be no one until the yield hits 4.65%. Such a wide range is associated with a rapid decline in yields in 2007, when investors began to price in the risks of a recession in the US. The stock market is likely to face high volatility, which is unfavorable for Wall Street and for the shares with a high beta coefficient. Some of these stocks have already incurred large losses. Notably, the shares of companies which have spiked during the pandemic are now logging their biggest losses. In the next few weeks, the 2-year government bond yield is expected to climb higher. Therefore, the stock market is likely to face volatility and a further decline. That's all for now. Subscribe to our channel and keep your finger on the pulse. See you soon.